Well, there's a lot of interest in the liquidation of various assets that's owned by former ANC Youth League leader Julias Malema, but very few people understand some of the behind-the-scenes wheelings and dealings from banks, liquidators and lawyers in this space. In its cover story this week, Finweek lifts the cover on the repossessions market here in South Africa. My guest for this part of the show is Jessica Hubbard from Finweek, Julian Jones, who is National Head of Cliffe Dekker Hofmeyr's Insolvency Unit, and Vincent Tadden, Head of the Lending Product House at FNB Wealth. Welcome to you both. Thanks for joining us. So, Marc, the world of high-end credit gone bad was exposed by the whole liquidation process of Julias Malema's assets. But I suppose the conversation really is uncovering what takes place beneath the surface. And of course, there's some questions around who actually benefits from this whole process.
Sure. I think that, taking a step back, we kicked the story around about 4 months ago, and it was actually on the back of something that Bloomberg had done, where they had looked at the lifestyle of guys that are out there actually repossessing assets from movie stars, basically multimillionaires in the US. And it's a very fascinating situation because, whereas the ordinary man in the street, you can repossess their car, they don't have lawyers, security guards to protect their assets, etc. Mm-hmm. It was actually an interesting game of trying to get these assets. There were stories of being able to sneak onto boats in the middle of the night and stealing them from the dock, or grabbing planes out of hangars, etc. So it's a very interesting situation where you have the rich who are able to protect their assets versus the ordinary man in the street. And to look at what's happening in South Africa, and I think we look at Julias Malema as an example, was at one point he was untouchable. SARS could have said they were coming after him. Banks could have said they wanted to repossess assets. There are a lot of when you're in a position of prestige, you have this situation where you're protected.
Yeah.
And I think that this made for us a really fascinating look at what's actually happening in the South African market. And I think we start to find that there is quite a lot of issues looking at sort of behind the scenes around the liquidations and insolvencies market.
From your side, Vincent, just if you could give us an idea of contrasting the liquidation process between retail and, I suppose, people like ourselves and those of high net worth class customers.
Well, firstly, the luxury market didn't tank as much as the retail or consumer market back in 2008, 2009. So it was sort of like a year's lag. But with the luxury market, and we define at FNB Wealth the luxury market over 3 million rand, the actual demand for those houses is actually quite small compared to a house less than 2 million rand or $1.5 million. So what happens with the luxury market is that wealthy people tend to put them in trusts or structures, and some of those trusts and structures are outside the National Credit Act. So you don't use the National Credit Act to actually litigate and try to either repossess or try to sell the house. So inadvertently, sometimes we have to go the liquidation route, and there are shortcomings with the liquidation route. One being the costs involved, from lawyers to attorneys, liquidators, the auctioneer, and really there has been some issues regarding insolvencies and liquidators in the past, which we've been trying to address.
Okay, so let's get into those issues. What stands out as the biggest issue right now?
Well, back in 2009, we at FNB basically caught on that value chain of the insolvency process was manipulated from the runner that is used by the insolvency practitioners and certain liquidators, all the way to the liquidator using auctioneers who would sell below the market value and then unsell it at a higher value. You have insolvency practitioners who would actually understate assets or sell off the assets to place the customer in a technically insolvent position when they weren't in the first place. And with insolvency, what really happens, the difference between that and any one of us, is that with an insolvency, once you've sold the assets in a loss, the customer is not liable to pay the loss back to the bank. Whereas under the National Credit Act, which is doing it in your own personal capacity, that loss is still there for 20, 30 years because you take a judgment for 20 or 30 years. So, yeah.
Julian, give us the legal perspective and what's taking place, because, according to the article, they say that sometimes even the lawyers are part of this whole value chain, which apparently is, there's a bit of an underbelly to it. And, I'm not insinuating, of course, anything.
The insolvency system works based on a referral system, in that the attorney that the matter is brought to would have a liquidator that he usually works with. the liquidator in turn would work with an auctioneer to dispose of that property. So it becomes a close-knit circle of friends that would end up doing the transaction. With the bigger banks, the banks are able to negotiate a fee with the auctioneer. The normal base is 6% on the asset sale, but I'm aware that some banks will negotiate the auctioneer down to 3%. One of the difficulties is that the liquidation industry is not properly regulated in South Africa. There's no code of conduct, there's no code of ethics that binds any liquidator. And it's for this reason that liquidators are a law unto themselves. The master doesn't have sufficient capacity to deal with issues surrounding delinquent trustees or liquidators.
Is it an issue of capacity, though, in that it's something that's been hurried along by what's happened in the last couple of years from a broad economic perspective, or is it a structural issue in terms of being able to get regulation in place?
I think it's a structural issue. The issue surrounding the Unified Insolvency Bill was discussed in 2000. We are still awaiting the Department of Justice to come up with anything meaningful.
How does this bill change things?
It seeks to have one insolvency act regulating the insolvency industry. At the present moment, to be a liquidator, you don't require any formal education. With business rescue, they are requiring you to either be an attorney or to be an accountant or to hold some similar qualification. And the other issue is fronting that's come into the industry with PDI appointments. So there's no proper regulation and control of what liquidators do, and they're not accountable really to anyone.
Why do you think it's taken so long to get to this point where people are actually looking closely at the liquidators and saying, when are these new policies and reforms going to come into force? Why now?
People have realized how much money there is to be made in the industry. If a liquidator is taking on the sale of movable assets 10%, they can make up to 20 to 30 million on a liquidation. And people have realized that you need to control it. With BEE, you have previously disadvantaged individuals becoming liquidators who don't have the proper skills and who have not been trained. And you have what's come fronting is happening.
Let's talk about, from a bank's perspective, what you're seeing right now. I mean, more or less when it comes to the high net worth individuals who have credits, especially, I suppose, in movable assets, that has gone bad.
All right, so liquidations and insolvencies are down year on year. We still haven't gone to decade lows. I mean, the height was 2009. We find that wealthy people weather the storm much easier than the consumer market. The consumer market dove into the unsecured market to finance their lifestyle or just to make ends meet when the interest rates were quite high. So wealthy people did have stockpiles, they did have shares, they did have tradable securities, something liquid to live through the cycle. But the people that are actually in the wealthy space that have actually got into any form of default have actually just leveraged themselves, or businesses that are self-employed, entrepreneurial clients, just fallen on hard times.
Are you worried about the fact that they've leveraged themselves to get out of some of their debt? I mean, is it getting to worrying levels or manageable? Very
manageable. We use rigorous back testing, we use behavioral triggers, we use scorecards to actually to even look at customers who are performing, that they won't fall over, going into a next interest rate cycle, which could be increasing. So we're very comfortable right now. Unfortunately, we, like any other retail or consumer bank at FNB, the wealth bank has also fallen, through defaults, not just material, but when you lend 10, 15 million rand on a house, you have much more to lose than a house that you've lent at million rand.
Sure, but I think that's the question then, is that, the old saying is, if I owe a bank $100, it's my problem. Yeah. If I owe you 100 million, it's your problem. Yeah. And I think that the question then says, what do you do, what is the plan of action when you suddenly realize a big client is in trouble?
Okay.
Suddenly you've got liquidators circling around certain assets. How do you who do you look after first? I mean, you don't want the client to obviously fall into a situation where you're not going to realize maximum value on the asset.
In most instances, with the private banking approach, the client is going to talk to the wealth manager or the private banker, and then we're going to assess quite quickly whether this stack of cards has fallen down. One of the things at FNB we did when we uncovered what was going on with insolvencies was we ensured that the liquidators were on our panel, and the liquidators had to use our approved auctioneers and estate agents. So we've got a program called QuickSell at FNB, and what QuickSell does is it actually uses estate agents and auctioneers approved by FNB to get the highest value of the security, because that's what we want. We want to sell the assets at the highest possible value. And
would you like to try and help your high net worth individual, the person you're representing, get out of the mess? And then, of course, the liquidation or that process is worst case scenario?
Worst case scenario is definitely liquidation because of the costs involved and the time period involved and the legal costs involved. We prefer working with the client to sell the assets privately to actually get the highest value. And normally what we do is we actually offer a discount to the clients to talk to us early, use our channels to sell the asset, and then if there is a loss, we would give you up to a 50% discount on it.
From a legal perspective, though, I mean, what is your take on this idea of having preferred suppliers, preferred channel partners? I mean, isn't that simply taking what you're seeing in the liquidator sector at the moment and then basically sticking it into a relationship that's already there with the banks? I mean, is that a healthy situation going forward?
It provides some control over the liquidators or the auctioneers, that the banks would carefully monitor and manage the process. So liquidators are not then their own boss. They have a structure within which to report into.
And is that one of the major changes that you'd like to see coming through into the industry, is more formalisation in terms of those relationships?
There needs to be some transparency in the system. There needs to be some accountability in the system as well. And that's what's severely lacking.
Who's benefiting the most out of this? The people, the kind of wealthy people. Who is getting the most out of a system right now that doesn't have the correct regulation? And I see a smile on your face, Vincent, so I'm going to throw that to you.
Well, the banks ultimately take the loss. So the value chain of the insolvencies and the lawyers take their fees from the proceeds. So for us, as a creditor, as a preferred creditor, we suffer the loss on the balance sheet.
And from your side, Jenny?
We try to maximize the return to our clients, who would be the banks. You need to realize that there are certain debtors that will hide their assets, and they are not just going to hand over the assets to the bank to actually dispose of. And you actually need to go and track down those assets, and that's where the legal costs come in. And it's expensive to litigate. Just an advantage that the liquidation process has is, on a normal summons procedure, you could wait between 3 years before you're in court. On a liquidation scenario, you can be in court within 6 months. So you can extract the value from the asset and put it back into the economy.
So who's responsible for injecting capacity into the liquidation and the masters of court? I remember trying to find the master of the court issue and trying to find a master to serve a summons. And it fell to me to go and physically find the master, to go and give him the summons to be able to hand over. Who's responsible for injecting that capacity into that segment of the market?
It would be the Department of Justice. It would be their responsibility.
And are they making any progress there?
Some progress.
Yeah. Okay, well, let's follow up on that one. And as you say, the new insolvency bill is one that we're waiting for and have been for some time. Thank you for joining us to unpack this. Of course, that Julian Jones, he's a national head of Cliffe Dekker Hofmeyr's insolvency unit, and Vincent Tadden, head of lending product house at FNB Wealth. It's time for a quick look at the Finweek trade of the week. So this week's trade of the week is Exxaro. Blue chips here.
Sure.
Tell us about that.
Well, I mean, I'm kind of a little bit hesitant. Having watched African Bank get wiped out last week, I'm always a little hesitant to just work on the concepts of price to earnings, multiples, etc. But Exxaro does look like a really interesting story at the moment. It's trading about $142 a share. Price to earnings multiple single digits. You're getting a good dividend there. There's a lot of interesting assets there, and I think that they tend to, I mean, if you look at the mining production numbers, etc., they don't look great at the moment. But what was very interesting, if you look at the jobs report recently, interestingly, mining was one of the sectors that added jobs. And what's encouraging there is that there is probably some uptick in the global economy in terms of resources, raw material processing, etc. And I think that Exxaro is probably one of the natural spin-offs from that.
What's your thought process, though, around the iron or coal, aspect of their portfolio?
Okay,
given relative to others, I mean, BHP Billiton, much more diversified. They've got that energy element. So, why Exxaro over BHP?
Look, I think that BHP probably gives you a smoother set of assets. Exxaro Exxaro gives you a very, very specific set of assets. I think if you look, I mean, it's very interesting to watch what's come, all the coverage of WEF this week, and in terms of, you realise the size of some of those infrastructure projects that are going across Africa at the moment. There's going to be massive demand for iron ore, energy station, electricity stations, etc. There is plenty of demand for their core materials in the next decade. I think you have to believe that what's happened now is all of the mining companies, listen to the JSE, have ultimately been treated with a single brush, and they've been pushed down to very low multiples. Exxaro is a good business, they're entrepreneurial, management is well engaged in terms of the staff are well engaged, they've had fewer staff issues in terms of what you've seen at the other mining operations. I think that if you take a bet on Exxaro now, I think you've got a relatively good margin of safety going forward.